Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The AI chip supply chain is locked in a vice grip. We're talking about TSMC CoWoS advanced packaging capacity sold out completely through 2026. High bandwidth memory allocations exhausted across SK Hynix, Micron, and Samsung, and demand-supply ratios hitting 3-to-1 on critical AI accelerator chips. This isn't a temporary blip. This is a structural constraint reshaping semiconductor competitive dynamics and creating massive trading opportunities for those who understand the choke points. Let's start with the elephant in the room, TSMC's CoWoS packaging bottleneck. According to Reuters and confirmed by TSMC CEO C.C. Wei, chip-on-wafer-on-substrate capacity is completely allocated through 2026. This advanced packaging technology is essential for AI chips because it stacks multiple components vertically, enabling the high-performance computing density that large language models require. Without CoWoS capacity, you can't ship cutting-edge AI accelerators. Period. Here's where it gets interesting for traders. Nvidia has locked down approximately 50% of TSMC's entire CoWoS allocation. That's a massive strategic moat. While competitors scramble for scraps, Nvidia controls half the global supply of the most critical packaging technology in AI hardware. This explains why Nvidia maintains pricing power despite competition from AMD, Intel, and custom chip designers at hyperscalers. The demand side is even more intense. According to reporting from Reuters, Chinese technology companies alone have placed orders exceeding 2 million H200 chips. Nvidia currently holds roughly 700,000 H200 units in inventory. That's a 3-to-1 demand-supply imbalance before accounting for North American, European, or other Asian customers. In response, Nvidia formally requested TSMC to commence additional H200 production starting in Q2 2026, which is happening right now. This ties directly into recent policy shifts. The current U.S. administration reversed prior export restrictions, now permitting H200 chip sales to China with a 25% fee structure. Chinese authorities are evaluating whether to approve these imports under the new fee framework, creating uncertainty, but also explaining the surge in Chinese orders. This geopolitical whipsaw is creating volatility in semiconductor demand forecasts and complicating supply allocation decisions across the industry. Let's pivot to the high-bandwidth memory crisis. SK Hynix has publicly stated that its entire 2026 HBM production, including next-generation HBM3E modules, is fully allocated. Micron and Samsung are signaling identical supply constraints. According to industry sources cited by Fusion Worldwide, HBM contract prices for 2026 delivery are increasing in the high teens to low 20s% range. That's 15 to 25% price inflation on a critical component that already represents a significant portion of AI chip bill of materials cost. This creates margin pressure across the ecosystem. Nvidia, AMD, and other chip designers face higher input costs. Hyperscalers building AI data centers absorb these increases or pass them to enterprise customers. Either way, this inflationary dynamic impacts profitability models and capital expenditure planning across the tech sector. For traders watching Nvidia, TSM, AMD, Google, AMZN, and MSFT, understanding these margin dynamics is critical for earnings expectations. TSMC is responding with aggressive capacity expansion. According to DigiTimes and confirmed by multiple sources including WCCF Tech, TSMC plans to increase CoWoS production from approximately 35,000 wafers per month in late 2024 to 130,000 wafers per month by late 2026. That's a 271% capacity increase in roughly 24 months. Massive capital intensity, but even this expansion barely keeps pace with demand growth trajectories. Here's the catch. With Nvidia reserving such a large percentage of that expanded capacity, available allocation for competitors remains severely constrained. Apple, Amazon, Google, Microsoft, and Meta are all developing custom AI chips, requiring advanced packaging. They're competing for the remaining 50% of capacity while simultaneously scaling data center buildouts that require these chips. This creates a prisoner's dilemma, where hyperscalers must secure supply commitments years in advance or risk being left without critical components. The investment response is staggering. Nvidia announced a $500 billion investment plan focused on U.S. manufacturing and AI infrastructure, according to reporting from Construction Connect and EIE Times. TSMC is committing up to $165 billion toward U.S. operations expansion, including 2 additional packaging facilities in Arizona. That's $665 billion in combined capital commitments, reflecting industry recognition that current constraints require fundamental capacity buildouts, not incremental adjustments. According to CNBC reporting from April 8, 2026, TSMC and Nvidia are collaborating on advanced packaging capabilities in Arizona. This represents strategic geographic diversification away from Taiwan, which concentrates over 90% of global advanced semiconductor packaging. Given ongoing U.S. China tensions and geopolitical risks surrounding Taiwan, this domestic capacity development carries strategic value beyond immediate supply chain relief. For traders, this creates several actionable insights. First, companies with secured supply allocations hold competitive advantages through at least mid to late 2026. Nvidia's dominant position in CoWoS allocation explains why the stock maintains premium valuations despite high forward price-to-earnings multiples. Second, memory suppliers like SK Hynix, Micron, and Samsung facing sold-out HBM capacity can sustain pricing power and margin expansion through 2026. Third, hyperscalers without secured packaging capacity face execution risk on AI infrastructure buildouts, potentially impacting revenue growth from AI services. The broader market effects ripple across multiple asset classes. In equities, semiconductor equipment manufacturers supplying TSMC's capacity expansion benefit from sustained capital expenditure cycles. Applied Materials, ASML, and Lam Research are direct beneficiaries. In fixed income, corporate bonds from TSMC and major memory suppliers reflect lower credit risk given strong demand visibility and pricing power. In crypto, GPU shortages impact proof-of-work mining economics and could influence hash rate distribution and network security dynamics for Ethereum Classic and other GPU mineable chains. Supply chain analysts at AI Magazine note that even with planned expansions, CoWoS capacity constraints will persist through mid-2026 at minimum. The lag between capacity announcement and production ramp means relief won't materialize until late 2026 or early 2027. This extended timeline locks in competitive positioning for the next 12 to 18 months. The hyperscaler response adds fuel to the fire. According to Digitimes, Google and Amazon are aggressively expanding AI data center capabilities despite supply constraints. This demand growth outpaces even the aggressive supply expansions TSMC is implementing. The result is a persistent supply-demand imbalance that supports elevated semiconductor valuations and justifies continued capital allocation to the sector. One critical risk factor, inventory dynamics. Nvidia's 700,000 unit H200 inventory against 2 million plus order backlog creates potential for demand disappointment if macro conditions deteriorate or if enterprise AI adoption slows. However, current data shows no signs of demand weakness. Hyperscaler capital expenditure guidance for 2026 remains elevated, with Meta, Microsoft, Google, and Amazon collectively guiding to over $200 billion in infrastructure spending, much of it AI-focused. Long-term structural implications extend beyond immediate supply shortages. The industry is fundamentally reshaping around domestic manufacturing, strategic partnerships, and vertical integration. Nvidia's $500 billion investment signals intent to control more of the supply chain vertically. TSMC's U.S. expansion reduces geographic concentration risk. These shifts create new competitive moats and alter industry structure in ways that will define semiconductor dynamics for the next decade. For active traders, the playbook is clear. Overweight semiconductor stocks with secured supply chain positioning. Focus on companies controlling critical choke points like advanced packaging and HBM. Monitor hyperscaler capital expenditure guidance for demand signals. Watch geopolitical developments around Taiwan and U.S. China semiconductor trade policy for volatility catalysts. And track TSMC capacity utilization data for early signals of supply-demand rebalancing. The AI chip supply chain squeeze represents one of the most significant structural shifts in semiconductor history. The combination of unprecedented demand, constrained manufacturing capacity, and massive capital investments is creating winners and losers that will define portfolio performance across tech exposure. Those who understand the bottlenecks, the allocation dynamics, and the investment responses will identify the alpha opportunities in this historic market dislocation. That wraps your market intel. Trade smart out there. For deeper insights in real-time analysis, visit capitalcopilot.io.